Hi everyone, welcome to the inventory management video lecture. So this video will cover chapters 10, 12, 13, and 14. Okay? Assignment to complete, and then you also have a written assignment and you have a connect assignment. All right? That's it. Thank you. Good luck, guys. Have a great day. Bye-bye. So some of the objectives from chapter 10. Explain the different types of inventory, the challenges of inventory management and the reasons for the existence of inventory. Evaluate inventory turns and days of supply for different time periods. Evaluate turns and days of supply from financial reports. So there are actually two ways of measuring turns, which we'll get into, and you have operational turns and financial turns. And then you have the next thing is evaluate holding costs and so on. So what is inventory? Well, the book ties this to Little's Law, where we spoke about inventory is equal to, remember, I is equal to RT, right? Where inventory is equal to flow rate times time. And, they mentioned three different types of inventory. You have raw material. That's inventory that's not being worked on, right? It's just the raw components. So if you're thinking about baking a cake, the flour and the butter and the salt, those are all raw materials. Then you have the work in process, which is inventory that is inside the process, but it hasn't started, or it has been started, sorry. So if you think about like the cake mix, like the powder, when you add all the flour and the salt together, that's whip or work in process. So another term for work in process is whip. I'll just put that there, right? Another stage in the process would be like the dough when you've added the milk and the eggs and everything else. So all of that is considered work in process. And then the finished good now is the baked cake, all right? So that's the finished goods and it's the process. The process is complete and it doesn't require any additional processing. So when the cake is done, if you're going to frost it, it's frosted, it's complete. That's the finished good. So those are the three stages. So once again, raw materials are three types of inventory. Raw materials, whip or work in process, and then finished goods. Inventory management is the practice of regulating the quantity, location, and type of inventory in a process. It's critical for the success of the organization. Things that are related to inventory management is forecasting, right? It helps you understand how well the future demand can be predicted. Data tracking and analysis, any investment you might need. Inventory exists for several reasons, right? As a hedge against the unknown, to ensure that you have enough inventory on hand to serve your customers when they need it. To plan for seasonality. So now we're coming up to Thanksgiving. There's going to be a huge increase in inventory of turkeys. Okay. And also to take advantage of volume, like pricing. If you purchase a certain amount, you'll get a discount. So you might choose to carry a little bit more inventory on a particular item than usual because of a volume discount you might be getting. Think of it also from a grocery perspective. When you go to the supermarket, sometimes they're having sales on, I think ShopRite does 10-10 or the can sale, right? So you get 10 canned goods for $10. So normally you probably just maybe need 2 or 3 cans of something, but because they're in the can sale, then you might buy 10, right? So that you're going to carry more inventory of that product. Then you have the production or smoothing strategy, which is a strategy for scheduling production, such that the rate of output remains relatively stable over time. And then finally you have what's called safety stock or safety inventory, and that's where I mentioned before you have a buffer against any demand uncertainty. It could also be not just demand uncertainty, but also supply uncertainty. Some of the key terms, or we're starting to get into the definitions now, where we start talking about inventory turns and days of supply. Days of supply is the average amount of time in days it takes for a unit to flow through a system, or it takes for the unit the inventory to be consumed. And inventory turns is the number of times the average inventory flows through the process. So So here we're getting to some more of the formulas. There's the supply. That's, linking it back to Little's Law. It deals with the time and the flow time. And then turns is the annual cost of goods sold divided by inventory. Or turns could also be revenue divided by inventory at that time. We'll talk about that a little bit later. All right, and then days of supply can also be calculated by 365 times inventory divided by the annual cost. Let me just move ahead, see, okay. But let's get into some examples so this all makes more sense. Zagos sells shoes and currently has 1.5 million shoes in its inventory. It sells 10,000 shoes per day. So what's the days of supply? So you take the current inventory it has, which is 1.5 million shoes, divided by your daily demand, which is 10,000, and you get 150 days in shoes. So it's 1.5 or the 1500000 divided by the 10,000 to give you 150 days supply. That's how long those 1.5 million shoes will last, given the current rate of demand at 10,000 shoes per day. Here's another one. It's a little harder to read the font, but a retailer has $500,000 in inventory and sells $15,000 per day. What is the days of supply? So you take the 500,000, divided by 15,000, and that gives you 33.3 days of supply. Okay, pretty straightforward. Another example, it says, Dawn reports, or bakery, I don't know, I can't see it properly, but reports that it has 20 weeks of supply of road salt. So a town reports that it has 20 weeks of supply of road salt. What is the months of supply? So remember, you should be able to convert from days of supply to weeks of supply to months of supply. So to move from days of supply to weeks of supply, you divide by 7. And then to move from weeks of supply to months of supply, you divide by 4.33 or 4.28 or just 4. You'll always be told what you need to divide by in order to get, the right number. So if you have 20 weeks of supply of road salt, so it's the 20 divided by 4.33, and you get 4.62 months of supply. Okay? If you were just asked approximated, then it would be the 20 divided by 4 weeks in a month, roughly 5 months of supply, sorry. An automobile manufacturer sells its cars through a network of dedicated dealers. These dealers report that they have 65 days of supply of inventory. On average, how many days does a car remain on the lot before being sold? If they have 65 days of supply, then on average, it will sit in the lot for 65 days. All right, and that was pretty straightforward. So we spoke about turns, right? Inventory turns. So there are 2 ways to calculate inventory turns. The first is what they call operational turns, right? This means how often do you have to replenish your inventory, right? The total inventory load. Not just how long will the inventory last you, but how often within a year do you have to replenish it. The higher the turns, the better it means the faster your inventory is moving, which is always a good thing, right? So some industries will have higher turns. Let's say grocery stores, right? They will turn maybe 30 to 40 times a year, meaning they're turning the groceries, Well, ideally, they probably want to turn the groceries maybe every 2 weeks, right? So it should be 26 to 30 times a year. Every 2 weeks, they're replenishing the grocery. Whereas a jewelry store, they might only turn all their inventory once or twice a year, right? So each industry is going to be different. But the higher the turns, it means the faster you recoup your cash, right? The faster you get your money back, and then the faster you can reinvest it into more goods or services that you need to provide to your customers. All right, so the higher turn, the better. But it's also industry specific. So public-related reported financial information can be used to evaluate a company's annual inventory turns and days of supply. A couple other definitions here are stockouts. A stockout, or when you're out of stock, occurs when a customer demands an item that is not available in inventory. Yeah, another way, whenever you get a rain check, means they didn't have something in stock, right? So that's a stock out. And then the opportunity cost of capital is the income not earned. And that's when they talk about inventory management and working capital, and that's a term you'll probably hear if you ever end up in operations, working capital. It's all the cash that they've used to buy the inventory, right? And it's tied up. So you want higher turns because the faster you sell off all that inventory, the quicker you get the cash back and for you to go and pay your bills and to do whatever you need. Some companies, they're sitting on way too much inventory and so they're cash poor, right? They have assets, but if nobody's buying the product, who cares? Who cares, right? It's all about having the right balance of inventory to match demand, but then also having enough cash available to pay your bills. Inventory storage cost, right? That's our holding cost, is the cost incurred to properly store, maintain, and ensure inventory. And then you have the obsolescence cost, which is a cost associated with losing value over time because of either technological change or shifts in fashion. So what happens a lot of the time, it's if you think about cell phones, right? We're changing them every year, or in some cases maybe every 6 months. I don't know. Maybe every year is a good number, right? And there are certain other things like seasonal items, right, that become obsolete after 3 to 4 months. So you, as a business owner or as a manager, you don't want to get stuck with that obsolete inventory, meaning it's no good anymore. Nobody wants it. You have to mark it down, right? Or you have to donate it or just, salvage it, sell it somewhere at a really marked down price. Like sometimes if you go in a 99-cent store, they'll have, what they call it, like expired items, not, or almost at the end of the shelf life kind of thing. And they're selling it dirt cheap. And that's because somebody went and bought too much inventory and they didn't sell it, right? And so now it becomes obsolete. They can't sell it at the regular price anymore. Other definitions are spoilage and shrinkage costs, right? So that's costs associated with theft or product deterioration over time. You want to minimize that as much as you can. And then you find you have your holding cost percentage, which is the percentage of the item's value that that it costs you to hold an item in inventory and storage. So this one deals with operational terms, okay? This example. It says Fresh Organic sells organic groceries online. Its annual sales are now $10 million and it has $50,000 in inventory. What are its annual inventory turns? So in this case, your turns are equal to revenue divided by the inventory value at that particular time. So in this case, it's $10 million divided by the $50,000 and you get 200 turns per year, which is excellent. Does it happen in reality? Not likely. But hey, this is just an example. So once again, it's the operational turns, right? Where we're using revenue divided by inventory to give you the operational turn. Now we're going to look at an example with financial terms. Okay? So it says Widner Industries reports annual sales of $160 million, cost of goods sold of $120 million, inventory of $20 million, and net income of $5 million. There's a lot of information here, so the question is what information applies? So here we're going to use financial terms, right? So the formula for that is actually going to be your cost of goods sold divided by the inventory. Okay? So that's the difference. So the financial terms is equal to cost of goods sold divided by inventory. So cost of goods sold is 120 divided by inventory of 20 million, so it turns 6 times. And that's it, 6 turns per year. What are the months of supply of inventory? Easily, you could look at it, you could do it a couple ways. It's the 120 million per year, which is your cost of goods sold, to tell you that you do okay, which translates to $10 million a month. So it's 120 divided by 12 to give you $10 million per month that you're spending to buy inventory. And then your months of supply is equal to the $20 million that you have in inventory divided by 10 to give you 2 months of supply. Okay? So your months of supply in this case, it's the cost of goods sold divided by 12 to give you the monthly cost of goods sold. Then 20, which is your inventory value, divided by 10 to give you 2 months of supply. The example in the back, where we turn 6 times a year. So it's 12 months in a year. So it's 12 divided by 6 to give you 2. Okay? Okay. A hospital reports that it has 10 days of supply of blood. What are the annual turns? So first you have to convert the 10 days of supply to years of supply. So if you have 10 days supply, then 10 over 3, 65.0274 years worth of inventory. Right? So in terms of turns, the turns would be 1 times your annual demand, basically. Right? Is it your annual demand? Not your annual demand, sorry. Your annual or your years of supply. So here it's 1 over the years of supply to get the turn. So it's 10 days over 365. No, sorry. 1 over 0.0274 years to give you 36.5 times per year. I don't think I'll ask you that on a test, but it's good to know. Next, a wholesale reports that a distribution center turns its inventory 5.6 times per year. So what's its months of supply? Really, I would just take the 12 divided by 5.6 and you get the answer. Okay? So it's 12 months in a year. You turn 5.6 times a year. So it's 12 divided by the 5.6 to give you 2.15. Same thing. So that's another way of doing the calculation. Here's another example. So we're given financial information for a supermarket, and they want to calculate the supermarket's inventory turns. So we know the cost of goods, it's 76,858, and the inventory is 6244. So the turns then are equal to 76858 divided by 6244, and that gives us 12.3 times per year. And that's up here. Okay, and then they want to know what are the days of supply with this new chart. So then you take the revenue per year. Sorry, you're given inventory at 8,600. The flow rate is 33,194 per year. Years of supply, it's 1. It's I over R to give you 0.259 years. So days of supply is 365 times the 0.259 to give you 94.5 days. Hope that's clear. So moving on now, let's talk about holding cost of an item. So inventory holding cost as a percentage of cost of goods sold is equal to annual holding cost percentage divided by annual turns. You're going to be given the percentage holding cost, okay? And you're either given turns or you have to calculate turns. So most companies assess their inventory holding costs as a percentage of the cost to purchase an item. So for example, if an item costs $50 and the firm assigns a holding cost percentage of 30%, then it costs the firm 0.3 times 50, which is equal to $15 to hold that item in inventory for an entire year. So let's look at that again. If an item costs $50 and you have a holding cost percentage of 30%, then for the year it's going to cost you the $50 that you purchased the item for times that 30% or 0.3 to give you $15 that you're paying to hold that item for the year. The actual inventory holding costs incurred by the items will depend on how long it spends in inventory. So that initial calculation, right, is based on you holding it for the year. However, let's say you turn the inventory 3 times per year. you would actually divide that $15 by 3 to get $5, right, as the holding cost. So here's another example. So the holding cost for the inventory at a retailer is 35% per year. The retailer's annual turns are three, and they purchase the dress for $50. So to calculate the holding cost now, it's going to be the $50 that they purchased the dress for. So it's a 50 times 0.35, which gives me $17.50. But that's per year. Now, because I turn my inventory 3 times per year, meaning every 3 times a year I'm buying this dress again, right? So then, how much am I actually paying to hold the dress each time? It's $17.50 divided by 3 to give me $5.83. So remember, you start out with the cost of the item times the holding cost percentage to get the annual holding cost. Then if you have turns greater than 1, so turns 2 times, turns 5 times, it's going to be the annual holding cost divided by the number of turns to give you the actual holding cost for that particular item. What are some of the consequences when a customer wants a product but it's not available? You can lose the sale and lose the customer. You can just lose the sale. You can lose the sale of the item, but the customer will purchase something else. Or the customer can wait for the item to become available. Some customers will do that if they're very loyal to you and very loyal to the product, right? But there are times when people just get annoyed and they'll buy something else, or you lose the sale and the customer, and they'll go to another store that normally has product in stock. Especially if you have a wrap where people can get the product that they want when they want it, then yeah, you're more likely to lose your customer. Okay? So going back to the holding cost example, I think that slide was in the wrong place. But anyway, Kohl's sells jeans for $40 a pair that it purchases for $20 a pair. Its annual holding cost percentage is 25%, and these jeans turn 10 times per year. What holding cost does it incur for each pair of jeans? So the first thing we want to do is we're going to look at not the selling cost, but the purchase cost of the jeans. That's what matters, okay? So remember, it's all about the cost of the item, not the selling price. So it's the $20 times 0.25, which is the percentage. All right, and that's going to give me $5. And I'm turning 10 times per year. So my holding cost is only 0.5 or 50 cents. And that's what we get here. We did that example. Okay. All right, so the ABC analysis. So let's say you're selling goods, which is your writing assignment, right? You're selling products on Amazon, or you're selling products, I don't know. You're selling a lot of potato chips, but you have some people like the plain chips more. Some people like, the salt and vinegar one. And then you realize that the jalapeno isn't the jalapeno chips aren't such good sellers. So you're trying to figure out what's considered your A SKU, right? So that's your high annual dollar volume, your best seller. That's your A SKU. Your B SKU is doing okay, and the C SKU, it's not doing so good. It's dragging. You find that you're building a lot of inventory on this, and you constantly have to mark it down because you don't want it to expire on the shelf. That's called your C SKU. So there are some policies or some rules in place that help you determine what's an A SKU versus a B SKU versus a C SKU. So an A SKU represents roughly 80% of your dollar volume. Okay? So the A SKU represents 80% of your dollar revenue. The B SKU represents the 15%, the bottom 15%, and your C SKUs are the bottom 4%. So A SKUs, the top 80% of revenue, then the next 15%, those are B SKUs, and then the bottom 5% of revenue, those are C SKUs. And then the example here goes into detail. How would you calculate the revenue, right? The volume, your annual volume that you sell, the unit costs, and then from that you can, the the volume times the cost to give you the annual dollar volume. And from there you can sort it and figure out what's your A, what's your B, what's your C SKU. Other criteria other than annual dollar volume may be used when determining A or B SKU. You can look at high shortage or holding cost, right? So meaning it's a priority SKU. You can't afford to tell Walmart, hey, I don't have the item to give you to put on shelves. So there's a high shortage or holding cost. You're going to lose Walmart as a customer, or you're going to lose Amazon as a customer. You can't sell your products on Amazon if you're constantly out of stock, right? So that's something you might decide to carry higher inventory on. And then anticipated engineering changes, delivery problems, or quality problems. So the thing too, with A SKUs, you want to have 99% or 98.5% service or better, right? Meaning, every time somebody comes to purchase this product, it needs to be available at a minimum 98.5% of the time. Ideally, you want to be in stock 100% of the time, but that's very expensive and not always possible. So your threshold should be at a minimum 98.5% of the time people can find the product. B SKUs, you want to have 95% service or better, right? So every time they come to buy the product, you want to ensure that 95% of the time they can find it. And C SKUs could be anywhere from 85 to 90% service. It depends on the business and, what you can do. You can even divide your C's, further divide the C's into C's and B's. So the C's would be 90, and then anything else below that would be, 85% service or less. So here for A SKUs, you want to focus on having a better supplier relationship to ensure there's no disruption in your service or supply. You want to have tighter physical inventory control on A's, meaning you might carry a little bit more inventory. And you want to do a better job at forecasting A SKUs, because you want to get the forecast right to ensure you have the right amount of product and right amount of inventory at all times. So that was chapter 10. Chapter 12. So here now we get into what's called the EOQ model, where we look at how do we order the optimal or the right quantity. And we want to make sure we know we need to carry inventory, but we don't want to order too much. And the whole point of EOQ here is we want to minimize our costs, right? So the point is that we need to minimize our inventory holding costs, and we need to minimize our ordering costs. And so that's how the EOQ comes out. There are a couple of assumptions with the EOQ. It assumes that my demand rate is constant and known, which is, this is an ideal scenario, right? It's a good starting point to figure out how much inventory to have. So if the world were perfect, how much would you order? So demand occurs at a constant rate. It's given or told. There's a fixed order cost. So every time you place an order, they charge you a setup cost or some kind of setup fee or order fee. And then there's a holding cost per unit, lower H, okay? So the demand is called R, the fixed order cost is called K, and the holding cost is H, right? So EOQ is a model used to select an order quantity that minimizes the sum of ordering and the inventory holding cost per unit of time. All demand is satisfied from inventory. Inventory never spoils, it doesn't degrade, and it doesn't get lost. And the assumption is that everything you order gets sold. Orders are delivered with a reliable lead time, and the lead time, is the time between when you place an order and when you get it. So that's reliable, it's never late, everything's perfect scenario, perfect world. And this is, as I said, a great starting point. Okay? The goal of the EOQ, as I said before, is to minimize the sum of all order costs in a period of time. The ordering cost per period of time. So the order cost is the sum of all fixed costs, right? The holding cost is the cost of holding the inventory, and the EOQ is the sum of both holding and ordering the inventory at any given time. Order cost once again is K, holding cost is H. It's just repetitive. And then you have the setup costs. Examples of holding costs, like when you're thinking about housing costs, that's about 6% or so. Material handling costs could be anywhere from between 1 to 3.5%. Labor costs, 3 to 5%. These are the components, these are the things that build up holding costs. So when you think of holding costs, it's not necessarily just how much is it to rent space in a warehouse, but it's also other costs, right? So you have the labor costs of people, staff in the warehouse, the material costs, the housing costs, the investment, like if you had to borrow money to buy inventory, the risk of theft, the risk of it going obsolete, and all of that added up, average carrying costs or holding costs is about 26%. When I did this kind of analysis at work, we used to use 10%, but in reality, holding costs can be anywhere from 15% to 40%. Your industry, you will know once you start doing the analysis, you will know the industry. You will know what your industrial rate is and what to use. So one of the things to mention is that as e-commerce has grown and more people are, storing items in warehouses, and Amazon is growing and taking up all the available warehouse space, and everybody's selling online and you got to store stuff somewhere, holding costs have gone up. Right, so the cost of storing stuff in the warehouse is a lot more expensive now than it was, let's say, 5 years ago. Or what's also more expensive is the labor costs have gone up as well, right? Because people work in warehouses, they're demanding more money. Okay, so if you want to keep your staff and you want to keep the warehouse staffed, then you're gonna have to pay them more. So then you pass that cost on to people selling, who sell your products and so on. So that's something to note. Okay, so the way that what this is saying, right, is basically you're at zero inventory. You place an order, you get the receipt in, and that's at you're at your maximum inventory, and then you're gonna deplete it all the way down. When you're halfway there, which is what we call the average inventory on hand, when you're halfway there, which is Q divided by 2, it triggers another reorder. So by the time you place the order, you're gonna keep depleting, but before you reach zero, the next replenishment comes in. Once again, you deplete it, you reach halfway down, average inventory on hand, you trigger another order, bam, you deplete it, then you get another receipt, you get another shipment. So the objective, once again, you want to minimize your costs. That's the objective of EOQ. So what are some of the key formulas here? So average inventory during the unit of time is Q over 2. The holding cost is equal to half times little h times Q. Number of orders that you'll place in a period of time, let's say the year or so, is your demand divided by the quantity. Ordering cost is K times, so the K I think was the order cost divided by the demand divided by the quantity that you're going to order. And in total holding cost is the holding cost plus the order cost to give you total ordering and holding cost per year. And the big kahuna, which is your EOQ or economic order quantity, or Q asterisk, is equal to the square root of 2 times K times R divided by little h. Let's bring that to life. So a retailer purchases a snowblower for $400 and sells it for $600. The retailer incurs a 25% annual inventory holding cost. What is the holding cost per year? So remember, it's always about the cost to buy the item, right? So we bought it for $400. And the holding cost percentage, which is little h, is 25%. So the holding cost per year is 25% times the 400 to give us $100. Back too far. So a drill in a hardware store incurs a holding cost of $10 per unit of $10 per year. The store sells one of the drills all week long, and each time the store orders more drills, it orders a case that contains 12 drills. What is the average inventory of drills in the store? So a lot of things, you have a lot of information is thrown at you. We'll use it all in later examples. But remember, average inventory sorry, is equal to Q over 2. So it says that every time you place an order, you get 12 drills. So it's the 12 over 2 to give you 6. Excuse me. Right? If you remember here, it says that we sell one drill each week, all year long. So the next part of the question is, what holding costs does the store incur per year to stock this drill? So the holding cost formula, it's equal to a half times H, which we're given, times Q. So it's 0.5 times the $10 that is stated, times the number of drills that you buy each time, which is 12, to give me $60. So in a year, 50. So then now the next stage, same, we're still talking about the drill. It says the hardware store incurs a $6 cost with each order. What ordering cost does the hardware store incur? So the formula is equal to K times R divided by Q. What's R? Right, so we know our order cost is 6. Right, it tells us that here. It says each time we place an order, it's $6, so that's our big K. Or R is equal to 52, right? Because if you go back, so we know that our demand is 52, right? If we sell one drill every week, so it's 1 times 52, so it's 52 drills per year. And every time we place an order, the Q is 12. So once again, our order cost is equal to K, which is the order cost per order is $6. Our annual demand is 52 drills divided by the order quantity of 12, and that gives us $26. So that's our ordering cost for the entire year is $26. So here we're talking about somebody called Zuder. And they charge $300 per order. And you order 700 caps per week. And the annual holding cost is per cap is 40 cents. How many caps should Zuder order to minimize the sum of ordering and holding costs? So whenever you see they ask you to minimize the sum of ordering and holding costs, you know you want to calculate your EOQ. Okay? So EOQ is equal to the square root of 2 times K times R divided by H. So we know square root of 2, we were told $300 for every order, times our annual demand. We know we need 700 caps per week. Oops, sorry. So it's 700 times 52. Right, 52 weeks in a year, divided by the 40 cents. Right, which is the holding cost that we were given for each cap. And that adds up to $7,389. So every time you order, they recommend that you buy 7,389 caps every time you place an order in order to minimize your ordering and holding costs. So let's go through it one more time. So you have a supplier, right? And they charge you $300 every time you place an order from them. Your demand, meaning you sell 700 caps per week, and your holding cost per cap is 40 cents. The question says how many caps should you order each time in order to minimize your ordering and holding cost. Whenever you see that phrase, minimize ordering and holding costs, it's EOQ. Or if you see they ask you what's your optimal order quantity, that's your EOQ again. So because the holding cost is given, our holding cost is 40 cents. Your annual demand, right, is 700 caps per week times 52 weeks in a year to give you 36,400 caps. The EOQ formula is 2 times the $300 that you're going to get charged times your annual demand of 36,400 divided by the H, which is 0.4, and then you square root all of that and you get 7,389 caps that you need to order each time you place an order. Let me just throw this in there. If your demand is 700 caps each week, and every time you place an order, it's 7,389 caps, how long do you think that inventory lasts you? Right? If you're selling 700 a week and you have roughly 7,000 coming in each time, then you have 10 weeks supply, right? So this is 7,000 divided by the 700 to give you 10. So you have 10 weeks supply. So how many times per year would you place an order? So let's say on average you order 7,000 each time you're going to order, right? And you're going to order 7,000. Your annual demand is 36,400. You need 700, and the 7,000 represents 10 weeks. How much would you order per year? So it's the 52 weeks in a year divided by 10. So maybe you're going to order roughly 5 times per year. Are you with me? Well, you can't answer, but anyway, I hope you get it. Listen again. Each time you place an order, it's 7,000 caps. That's what you're going to get, roughly. That's 7,000 caps based on a weekly demand of 700 caps each week. That 7,000 caps lasts you 10 weeks. That's 10 weeks of supply. There are 52 weeks in the year. So to determine how many times you're going to order caps for the year is 52 divided by the 10 weeks. And that's roughly 5 times per year. Okay. Going back, I have to think it through and work through the math, okay? Work through it so it makes sense. A firm's demand rate is 1,000 units per year. If the firm orders 400 units per order, how many orders does the firm make per year on average? Here's another example. So the demand is 1,000 per year, and every time you place an order is 400. So it's 1,000 divided by the 400 to give you 2.5 orders per year. Oh, this is a long one. I don't think I have a lot of space to write, but let's take a stab at it. So this is something about a coffee supplier and the seller. They have what is this? They place fish roasters. They charge them $25. They order, they have a holding cost of 24% per year. They order 125 bags at a time. Guys, I can't really read this because I have extra stuff on the screen. So what I recommend is that it basically employs all the steps that we just went through. So just go through this on your own, okay? But because I have too much stuff on my screen, but you will print it out and just take your time and work through it. Nothing new here is exactly what we just went through with the problems. So sometimes some suppliers will offer you a discount if you order in bulk, right? So sometimes they'll tell you to order in a pallet, which is like several layers of a product on, that wooden crate looking thing like, or they might ask you to just order a single layer, which is like a tier. And then you have to make that decision on whether or not you want to order the larger volume or the smaller volume. And what you have to do, right, because when you order in bulk, it increases your costs because now you have to spend more money up front, right, to buy that extra inventory that you didn't really plan on buying. It also increases your holding cost. But sometimes the volume that you've purchased reduces your purchasing cost because you don't have to place as many orders. Okay? And some firms choose to do that. When you do the math, basically what you'd have to do is calculate the sum of the holding costs and the ordering costs based on each quantity that you're given, right? You know your EOQ, but the discount is, you get a discount if you order, let's say, in a different volume. And then you have to calculate what's my total ordering and holding costs if I chose to order that volume or another volume. And whichever has the lower cost, then that's the one you go with. Okay? So this example here says, my EOQ, I've calculated it to be 775 units. However, the company wants me to order in quantities of 500. So I can either order 500 units or 1,000 units. So now I have to calculate my ordering and holding costs for each quantity. So when I calculate my ordering and holding costs for 500 units, my total cost is $850. When I calculate my ordering and holding costs for 1,000 units, it's actually less. It's only $800. So then what am I going to do? I'm going to order in units of 1,000 or batches of 1,000. Okay? And it makes sense because if my EOQ is 775, that's my ideal quantity. Why would I order a lower quantity than my ideal? It would be better to go up a little higher because that would probably bring my cost down on a unit basis. Same logic here. I'm not going to go through this example, but you guys can do it on your own. Why is my screen off? That's what's going on. Here we go. I'll skip this one as well, but please go through it on your... Okay, so chapter 13. And this is weird. My slides are just pushed up. So chapter 13 deals with how do you determine how much inventory you need when your inventory is perishable, right? So this works with newspapers. It works with lettuce that's being sold in the supermarkets and the bananas, right? You cannot store this inventory for months at a time. You can't store it for weeks at a time. As a matter of fact, you buy it one time and it's obsolete by the end of the day. That's why it's called a news vendor model. What this does is it forces you to really rationalize, what's important to you. You're trying to get to the... Now looking at things such as underage costs and overage costs. And what's my critical ratio, right? Definitions that I want to give you. Okay. So here are the key things. I'm trying to... The salvage value, right, is the value that can be obtained per unit of inventory left over at the end of the selling season or at the end of the day. The underage cost is the cost of not ordering enough inventory, so that means you've run out of two. And then the overage cost is the cost of ordering too many units where you have extra inventory at the end of the day and now you have to destroy it or sell it or salvage it. And then the critical ratio is the ratio of the underage costs to the sum of the overage costs. So let's see if I can find... Here it is. I'll bring this down a bit. I don't know why this loaded like that. But anyway. My shortage costs, right? So let's say I sell bananas. And I sell them for $1 each. I can't even spell, but bananas has an extra NAS. Okay? I sell the bananas for $1. If I'm out of stock, right? So I buy 5 bananas every day. And I don't have... If I sell out all my bananas by, let's say, 8 o'clock, and somebody comes to buy a banana, every time somebody doesn't get the banana they want, I'm losing $1 sale, right? So that's my shortage costs or my underage costs. I buy 5 bananas every morning to sell. I sell them for $1. Okay? Or let's say I grow the bananas. Every time I don't have a banana to sell, I lose $1. If I'm buying the bananas, let's say I'm buying them for 50 cents and I sell it for $1, then my underage cost represents my lost profit. So once again, I buy the bananas for 50 cents, I sell it for $1. My underage cost or my cost of not having the inventory to sell is my lost profit. Okay? So I'm losing 50 cents. So it's the $1 minus the cost of 50 cents. So I'm losing 50 cents per profit per banana. However, if I have bought the bananas, I've bought 5 bananas, and every day I'm going to sell 2 bananas, meaning I have too much bananas, I now have to deal with excess or overage costs. Okay? So I bought that banana for 50 cents. And what I can do, I can send it back to the farm for 25 cents and they'll use it as like animal feed or something. So how much am I losing on every extra banana that I've purchased? I'm losing 25 cents. That's my overage cost. So my underage cost is my lost profit when I'm out of stock. And my overage cost is how much money I'm losing for excess inventory. And this applies to the news vendor model or anything that's perishable or anything that has a seasonal component. So if you sell something that's really trendy and it only has a shelf life, people are only interested in it, let's say for a month or two. You remember like fidget spinners, right? They were hot for like 6 months, and then if you were stuck with inventory after 6 months, you had to mark it down. Same principle here. When fidget spinners were hot, if you didn't have enough, you were losing money, right? People were buying them for $1 from China and selling it for $10. So every time they didn't have a fidget spinner, they were losing $9 in profit on a sale. That's when something is hot. However, when fidget spinners, kids got tired of it and moved on to Pokemon or something else more interesting, right? People were stuck with millions of fidget spinners. So they bought those fidget spinners for $1, right? But they could only sell them now for 50 cents each. So they were losing 50 cents on every fidget spinner that they sold. Because they had to move the inventory. They couldn't sit down and hold on to it. Right? They're not worth anything to anybody because nobody really wants it. So now they have to give it away. And so usually the problem with a perishable item is that you have to sell it for less than you actually purchase it for. So when you salvage it, right, that's where the salvage value comes in. When you salvage it, you're actually losing money on the sale rather than holding something that nobody wants. So the service level or the critical ratio is equal to the cost of underage divided by the cost of underage plus the cost of overage. Okay? That's the critical ratio. Meaning that's at the minimum service level you want to have, for an item. So remember we were speaking about your A SKUs, your B SKUs, your C SKUs. So anything that's a big seller or something that you want to make sure you have, huge inventory on or enough inventory on, or the cost of being out of stock far outweighs the cost of having too much inventory, that would be like an A SKU or a B SKU, and that's where the service level comes in. You want to service it no lower than, 80% service or 90% service. Okay? So let me say that again. Items with high service level, such as an A SKU or B SKU. Remember we said A SKU you service at 99%, B SKU is service at 95% and above, right? Anything with a high service level, then the cost of being out of stock on this item, the cost of being out of stock far outweighs the cost of having too much inventory. So when you're out of stock on this item, you're losing so much profit, you're losing so much revenue that you rather carry extra inventory and have that higher service level because the cost of understocking is expensive. Okay. So here is an example. Let me pull this down a little bit. I don't know what happened when I loaded these. Probably too much slides. But anyway, it says something for 10. You buy it for 10. So the cost is equal to $10. You sell it for 25. And at the end of the season, you can only salvage it for $1. So it says, what's my underage cost? So my CU. So my underage cost here is going to be the lost profit, right? So it's the $25 minus the 10. So it's $15. That's my underage cost. Here's the question. It says, building on the same example now, what's my overage cost? So first it was my underage cost, which is my lost profit, right, which is $15. Now my overage cost is how much am I going to lose, right? So I bought the basket for $10, but I can only salvage it for $1. So I'm losing $9 in profit at the end of the season. Or sorry, not $9 in profit, just $9 period. I'm losing $9 at the end of the season. Okay. A news vendor determines that the underage cost is $100 and the overage cost is $25. What is the news vendor's critical ratio? So the critical ratio is equal to CU over CU plus CO. So the CU is 100 divided by 25 plus 100 to give, so it's 100 over 125, and that's equal to 0.8. So it has a high service level of 80%. So that means in this case, it's more important to have extra inventory than not to have enough. And this is where it gets a little bit more involved in a little bit what these things mean. So basically it's saying your ideal service level is equal to this, which we spoke about. Then it looks at what's the ideal quantity that you should order, which is mu, which is the average, plus the z-score, plus the standard deviation. And then to calculate it, you can also just use Excel, which has the formula of norm S inventory to calculate. Technical, it's hard for me to explain it without seeing you guys, so please read that to understand you. And it speaks a little bit more about in-stock probability and in-stock, the probability of being out of stock. So basically this gets at, and I'm not going to get into it, but what it gets at, it's, so you know your ideal order quantity, right? That's from the EOQ perspective. Based on the probability of buying too much or buying too little, you know how much inventory you're going to have at the end of the season, and then how much what your sales are going to be, and from that you can calculate your expected profit. What I will do for you guys, it's on your exams, I will give you the expected leftover inventory, because I'm not going to give you statistical tables in the exams, right? I will give you the expected inventory so you can solve the problems, as opposed to having you do the math in an exam. Somebody asked me the other day, like, why don't we do as much statistics as the other classes? And for me, it's more important for you to understand the concepts and actually enjoy learning the material as opposed to me teaching another statistics class. But really, I need you to get the concept, right? You can always go find the statistics formulas later, but I wanted you to at least enjoy learning the material, and you can apply it and remember how to think through it as opposed to trying to remember a formula. That's my perspective on the matter. Skip that. Okay. Skip this example too. I had some examples that included that. Did I not? To this. All right, guys. So let me it's not those. I'll have to come back. I will have to come back to an example. You can go through these, but I need to find, I think I cut something off. I will need to come back. But basically, what you'll be given, right, in a test or in an assignment, it's they tell you how much you're going to order, right? I will tell you how much inventory you're going to have left over. So you need to calculate your expected sales, then calculate the expected profit based on, the CU and the CO. The underage cost and the overage cost, and your critical ratio, and then calculate your expected profit. But I need to find the right example. You can also get in your text. Yeah, the question got cut off. Sorry about that. You can go through the examples in your PowerPoint. Yeah, you can go through the examples on your PowerPoint. Yeah, the questions got cut off. I apologize. But go through the PowerPoint on your own. You can find the worded questions, and then you can do the calculations. So here it says, a news vendor purchases 10 units for $10 and sells one for $18. Inventory salvaged at 6, and he orders 45,000 units, and expected sales are 10. So he has to calculate how much inventory is he going to have left over, right? So it's 45,000 units. Minus the 35 he's going to sell, so he has 10,000 left over. He calculates the profit, right? He sells it at 18 times the 35, which is the expected sales, plus the salvage value times the leftover inventory, minus the $10 times the 45,000, which is the total amount that was purchased, to calculate the expected profit. But you can, as I said, go through the slides on your own. You guys can work through it. It's basic math, right? So basically, to determine the expected profits, you have to figure out what's your total expenditure, right, to buy the inventory, minus what is your expected profit, right? So your profit is what you expect to sell times the full price, the revenue, plus the leftover inventory times the salvage value. And then you subtract all of that from your total, you subtract your total cost from that to get your expected profit. Sorry, it's all cut off. It's not working very well. So sometimes if you have too much inventory, according to this, you can throw in the towel or increase your profit margin relative to the cost of leftover inventory, or reduce your purchase costs, right? Everybody has to reduce a profit, so not likely you can reduce your cost, but really and truly probably just order less. And it's better to be out of stock in some cases than to have too much inventory. I can't believe all of the questions got cut off. Oh, this did not load well. All right, there are a couple things in chapter 14 I want to touch on. And just read it on your own, please, because once again it's getting cut off. It's the order up to approach. 2 is what I want you to get, right? The order up to inventory level. And then I've added some extra stuff at the end here, which is the reorder point. I can't believe this is happening. So just read the order up to level, right? Which is what I want to talk about. So let me just read it to you here. At the start of a period, a firm has 5 units on hand. So on hand is equal to 5 units. And the 3 units on order. Right? And will be received in 1 period. And then 7 units on order, which will be received in 3 periods. The order up to level is 22 units, so they want to know how much inventory should they order. So basically, they have 7 units on order. There's nothing. Let me just clarify this a minute, and I'm sorry. Bottom line with the order up to quantity, the order up to quantity really means it's the maximum inventory you should have on hand, right? It's the maximum inventory you should have on hand. So basically, if your maximum order up to level, so let's just clean this up and go from there. And this is where you'll get the concept. It's very straightforward. Okay? So let's say your maximum or order up to level. Oops, wrong pencil. Okay. Order level or order up to level is equal to 22. So that's the maximum inventory you want to have. If you currently have 5 pieces on hand, okay, and demand for 7, let's order for 7, okay, and you already have, let's say, 3 in transit, meaning already on its way to you. The question will be, how much more do you need to order? So you know your maximum inventory level is 22, plus the 5 you have on hand, minus the 7 that's already on, minus the 7 that the customer has ordered, minus the 3 that's already in transit. Because at no point do you want to have more than 22 units in inventory. So your order up to quantity would be 22 plus 5 minus 7 minus 3. 22 minus 5 minus 7 minus 3. So you'll order 9 units in order to maintain your target of 22 pieces maximum. Okay, that's what order up to it means. And then the other thing I wanted to take you guys through, it's reorder point. And I can't believe it got cut off. Shoot. But anyway, very quickly, the key thing with the reorder point here, it's So you know the ideal quantity to order, right? But you want to know when should you order. So the thing I gave you guys for your writing assignment, it's you're selling products on Amazon, and you want your, well, I'm not trying to give away the answer, but you're selling products on Amazon, and basically you need to know when should you replenish so you don't run out of stock, right? You have a hot seller, you know your ideal order quantity or your optimum order quantity, or the quantity that's going to minimize your costs. You know that, but you also need to know when should you place that order. Okay, how many days of inventory should you have on hand, or days of supply should you have, so you don't run out of stock. So the determinants of the reorder point, which is when do you place the order, okay, depends on the demand, the rate of the demand, the lead time, meaning how long it takes for you to get your items, and the extent of the demand or lead time variability, and the degree of stock out risk that's acceptable. So basically, and it got cut off again, but your reorder point is equal to your demand rate times your lead time in days. And this is your reorder point without safety stock. Okay, so if my demand rate is, let's say, 50 per day, and it takes me 10 days to replenish my inventory, so my reorder point, I will need to replenish my inventory when I get down to 500 units. Okay, so because it's going to take me 10 days to get to get new inventory, and I have to replenish 500, 50, I sell 50 per day. So when I hit 500, it triggers an order, right? And then it will take me 10 days to get however much my EOQ is, whatever my EOQ quantity is, then that's the quantity that I'm going to get. So if you remember, we saw something earlier, let me put it here, where you place an order, it gets depleted, then it triggers, you place another order, it gets depleted, and so on, right? So your reorder point is somewhere in here, and that's what triggers an order for you to get a new replenishment order before you run out of stock. That's what reorder point is about. So that's one thing I wanted to touch on. And then here's a quick example. It says annual demand for notebook binders at Myers Stationery Shop, it's 10,000 units. Brad Meyer operates his business 300 days per year and finds that deliveries takes 5 days. What's the reorder point? So here, right, we know our lead time is 5 days and our demand is 33 units per day, which is 10,000 divided by 300. So my reorder point is equal to my demand, which is 33 units per day, 33.3, times the 5 days to give me 167 roughly, or 166.7 units. So when I hit 167 units, it triggers an order. That's the reorder point, and I will order my. And once again, this got cut off. What this is saying, this is talking about safety stock. And what it's saying is that there are times when our demand isn't perfect. We don't know the demand for sure. Or, you have an idea of an average, but it's not necessarily the same number every time. Or there are other times when the lead time might not be stable, right? Shit might get delayed, or there might be a strike or something. What a lot of companies do, right? They have the reorder point, right? They know they're doing their EOQ, they're doing their inventory, but what they'll also carry is some extra buffer stock. Okay, so this is a buffer against uncertainty called the safety stock. And so that safety stock, right, is driven by demand volatility or any kind of unknowns. You can agree to just set a certain quantity, or it can be driven by days of supply, however many days of supply you want. If for some reason, right, let's say an order gets delayed and you get to the reorder point, but there's a delay, yeah, you end up eating into the safety stock. When you place your next order, you have to reorder your EOQ, okay, plus rebuild your safety stock. And this is just FYI. Okay? So once again, you normally order your EOQ, that's your quantity. Your reorder point, come on. Your reorder point tells you when to place that order. Okay? The reorder point tells you when to place the order, and the safety stock is the buffer. So, if when you hit the reorder point and there's any kind of delay in replenishment, or your demand is greater than normal, it will eat into your safety stock. When you place the next order, you have to order the EOQ plus the volume required to replenish the safety stock, because that's something you need to maintain. And that's it. I'm going to stop there. My slides are all messed up. I guess I had way too much slides. It didn't do a good job of loading it. But that's it for me from this lecture on inventory. Please take your time and read.